Welcome to your market brief for the week of February 10th. I'm Carlton English, in for Caroline Woods. Following a better than expected jobs report on Friday, U.S. markets remain volatile in the face of ongoing coronavirus fears. For more issues that will impact your portfolio this week, I'm joined by Diana Amoa, Senior Fixed Income Portfolio Manager with JP Morgan Asset Management. Diana, thank you so much for joining us today.
Thanks for having me.
So I got to ask first question, the coronavirus that's been weighing on markets over the last few weeks. What are the broader implications for the economy?
Well, there's a couple of things. I think what we're facing right now from a China perspective is something of a growth shock. We've seen demand has tapered off with this quarantine, and that also has rippling effects to the broader global economies because of the interlinkages of global supply chains. So in as far as markets are concerned and economies, I think Q1 numbers are probably going to suffer from what we're going through right now. However, there's an expectation in markets that if this follows what we had in 2003 with the SARS virus, we're likely to see a V-shaped recovery. So the second half of this year, we'll see a bit more of a tailwind from markets rebounding and activity picking up again in China.
So do you think it really will just be limited to Q1, or could it possibly overhang into Q2 as well?
I think that's the big questions for market right now. It feels like fixed income markets are perhaps less complacent about the risks of a prolonged shutdown in China and what the rippling effects into the broader global economy is. But equity markets for sure feel like they're trading more on the recovery, on this being a transitory shock. So there's two things we're watching. One is how quickly this tapers off, and then we start to see activity coming back online in China and that feeding through to the broader economy. But then also, to what extent have authorities been successful in containing it? So whether we see this spreading out into other countries in a more significant way.
And for our viewers, can you tell us a little bit more about what you mean about growth shocks and where you're seeing them?
So ultimately, China is a big part of the global economy now. And when you have a quarantine of the magnitude that we've seen, aggregate demand there drops quite significantly. The makeup of the economy has shifted as well, so it's not so much dependent on commodities and exports. Consumption in China does drive growth in other parts of the world. And this is that consumption contraction that we're seeing that is actually starting to spill over. We're seeing it feeding through into commodity prices. You can see the moves in oil prices since the headlines started to gain traction, but we're also seeing it in other commodity prices, agricultural prices, etc. So that kind of shock is rippling through asset prices, and that's what we refer to when we say there is something of a growth shock coming through from this.
And what does this mean for emerging markets? Are we still able to see opportunities there with some of these coronavirus spread fears and the slowdown in China?
Yeah, certainly. Ultimately, there's two things that are supporting financial assets. One is the expectation that we will see a policy response, whether it's from the Fed, with the markets now pricing in 1.5 cuts by year end this year, despite the Fed saying the economy is in a good place. But then also within emerging market, the response is going to be much looser monetary conditions. A lot of emerging markets have capacity to ease rates, and we are seeing them deploying that. So last week we had the likes of Thailand, Singapore cutting rates. This week we have the Mexico Central Bank. There's expectations they will be cutting rates. So for emerging markets, actually, the opportunities are in where we see capacity for policymakers to deploy stimulus. So we like local market bonds because we think actually there will be compression of rates there, real rates.
Okay. Well, thank you so much, Diana. We're going to have to leave it there for today. Thank you so much for joining us.
Thanks for having me.
So shifting to a quick look at the week ahead, the Trump administration is expected to submit its 2021 budget to Congress later today. On the campaign trail, the New Hampshire Democratic primary gets underway tomorrow. Plus, Fed Reserve Chairman Jerome Powell delivers his semi-annual monetary policy report before the House Financial Services Committee. On the economic calendar, we'll get more data pertaining to the health of the labor market. We'll also get a read on the U.S. consumer and retail sales. And another big week of earnings include Lyft and Under Armour on Tuesday, followed by CVS and MGM Resorts on Wednesday, then Alibaba, Nvidia, and Pepsi on Thursday, plus AstraZeneca on Friday. As valuations for equities remain high, our next guest says investors in search of growth should look for opportunities within private markets. Ian Sigalow is the co-founder of Greycroft, a venture capital firm focused on the internet and mobile devices technology. Since launching in 2006, Ian led early investments in companies including Braintree and Buddy Media, both of which were eventually acquired by public companies. Ian, thank you so much for joining us today. So tell us, what's the next big thing?
Oh, wow. I think over the past 2 years or so, we've been focused heavily on fintech as a firm. So if you look at our portfolio, we've backed Bright Health, which at some point will likely go public. It's a new health insurance company, part of our insurance thesis within our fintech portfolio. We're in ICA, which is the Square of China. We funded Yield Street here in New York. So it's like asking somebody to pick their favorite kid. I've got a couple, but our fintech portfolio in general is doing amazing.
Excellent. And then what's the playbook for companies as they go from startup to potentially unicorn to going public? How do we kind of avoid that WeWork situation that we had at the end of last year?
Yeah, there's a phenomenon right now in the market where companies are raising mega rounds and then they miss their numbers and then they do a layoff. Okay. And we see that a lot, actually. In terms of our own portfolio, the best advice we give entrepreneurs is take your time. You'll get there. We advise them also, through our corporate governance and roles on the board about budget setting processes, so you don't set unrealistic expectations and burn too much cash on your way up.
And have you found that there's been kind of a drying up of funding? That was the fear at the end of last year following some of the less profitable IPOs.
No.
Not at all? Okay.
Not at all. The public markets are important for our business. First and foremost, it's good for liquidity, but second, our companies oftentimes get bought by other public companies. So having a good year for IPOs means there's a lot more companies to acquire, the vast majority of venture-backed companies. On the flip side, though, LPs have gotten back probably $50 billion from IPOs over the course of the past few years. Uber being kind of a big name out there that generated a lot of proceeds for LPs. And that money has come back into the venture ecosystem. So VCs they're flush with cash.
Okay. So just looking at some of the innovation over the last decade or so, a lot of it wouldn't have been possible without kind of the smartphone and just some of the tech platforms we have. So is the smartphone the MVP of VC?
Yes. I think the iPhone and the smartphones that followed are likely responsible for 70% of all venture capital returns over the last decade, which is an astounding number.
Yeah.
It probably created more value than the internet, if you think about it, because it's Spotify, it's Uber, it's Lyft, which you just talked about having earnings this week. And not only that on the consumer side, but on the enterprise side, it's all of the tools that were built to enable people to communicate on their mobile phones. Even Zoom. You think about all of the video conferencing that's happening. A lot of their use is on the mobile phone.
Interesting. And you guys are based in New York. Tell us about the differences you see in New York versus Silicon tech talent. Is New York a big hub?
Yeah. The New York market is really deep right now. And 15 years ago, I wouldn't have said this. What would happen is Silicon Valley VCs would come to New York and they'd say, well, we'll fund you, but you have to relocate your company to the Valley. And that was really common. It actually gave us an advantage because we were local and we weren't insisting that our companies would move out west. Today, that doesn't happen anymore. In fact, they're telling companies stay in New York because the market for tech talent is deep. The market for marketing talent is really deep. There's a lot of big West Coast companies that have set up East Coast operations in New York with Facebook, Snapchat, Google. So you can go hire 1,000 people from one of these major tech companies and scale your operation fast.
Well, that's great news for New York, but Ian, we're going to have to leave that there today. Thank you so much for joining us this morning.
Thank you for having me.
Thank you. And before we go, Barron's wants to recognize the people and programs that are making an impact to improve the financial health of individuals across the U.S. For more information and to submit nominees, head to barrons.com/celebrates. And lastly, you voted on where shares of Tesla would be trading at by the end of 2024. The results are in, and nearly a third of you are quite bullish, saying that 7,000 is the next stop. That concludes today's Market Brief. However, we want to hear from you. Comment below and tell us if you'd rather own 1 share of Tesla or 100 shares of Ford. Let us know. Thanks so much for watching.